This morning, we had a pretty awful NFP report. Take a look at the S&P 500, which dropped big in the hour following the report. We have a spike up in the VIX. Gold prices are back on the rise. Silver also doing pretty well. And TLT is ripping higher here as bond yields drop in anticipation of more rate cuts. But are these the types of rate cuts that the market wants or the market fears? In today's video, we'll be talking about what has changed since we got this horrible jobs print. And this week was riddled with bad jobs data. So let's break it down and talk specifically about trade ideas for today and the week ahead. So welcome back to the channel, guys. Today I'm going to be breaking down the NFP report and what it truly told us about markets. First and foremost, let's dive right into the numbers. We expected 75,000 jobs to be added to the US economy, and we got an abysmal 22,000.
Holy mackerel! Now there's your spit take!
The US economy population, maybe we can pull up a screenshot of what that currently is, but the last time I checked, it was over 300 million people in the United States. So to add just 22,000 jobs shows a severe weakness in labor data. And this is following the prior month's number, where we also saw a significant miss in jobs added. In the prior number, we forecasted for 106,000 and got only 73,000. With today's revision, bringing that number up to 79,000. So really, we've had a string of weak jobs numbers. Layer on top of this week's weaker than expected JOLTS job openings numbers. So job openings are slowing, hiring is slowing, and unemployment rate ticked up to 4.3%. While on an absolute basis, this is still a very low unemployment rate, it is rising and something to pay attention to. Finally, unemployment claims are back on the rise. And all of this to say, the US labor market is slowing and it's hard to deny that. So what does that do to markets? Well, first and foremost, rate cuts are coming because now the market is potentially shaping from a, hey, great rate cuts to, oh no, rate cuts. And I think we saw this embodied in the S&P 500's 4-hour chart. You can see the initial break to the upside on excitement of weak jobs means we're gonna definitely get rate cuts, which fell apart into, oh my gosh, weak jobs may mean the economy is truly slowing. Gold is up 1% here, and this is just following a string of winning days. Metals continue to be the place to be, in my personal opinion and in my personal account. I'm still long SLV. I have 5,800 shares on the long side, making it my biggest position in my portfolio at this time. I've trailed my stop loss below market structure here where we gapped and ran. And as long as we continue to hold this area, I will look to continue to hold my silver or SLV long position. Of course, this is just an ETF that tracks silver prices. This trade, along with all of the positions that I take, are available inside of our VIP Discord. And if you're interested in getting signals sent directly to your phone and to your desktop, you can do so within our Discord server by joining the VIP group. The link is in the description down below. And if you speak to a support member using the first link in the description, they can get you an extra discount as a YouTube subscriber. Just shoot us a message letting us know you saw this video and then get you a nice discount. So my plan for silver is if we can get a break and closure today above the previous high, I'll look to trail my stop loss further into profit. And for traders feeling FOMO on gold, then you're not alone. I also don't have a long position on gold and would like to add one, but it has run away from me. There's nothing I can do here. In fact, this, believe it or not, may have been all the pullback we're going to get this week on gold prices, which was just a modest move on a daily chart level, even though intraday was pretty sharp. I really think that there's nothing we can do here if you missed the move on gold other than to sit back, wait, and catch the next one, but don't FOMO into this trade. In my personal opinion, that is a mistake that many traders will make. They'll start going heavy long just because they've seen it gone up every day, and when a modest pullback happens, it'll blow their account. Gold and silver are both still bullish setups within the Edge Finder. You can see the very bullish plus 11 score that the Edge Finder has been giving gold for the last few weeks. This has been spot on, and I don't just mean spot prices. Silver too has had a bullish reading, which is why I picked it up when it pulled back. I wasn't able to really get a good pullback on gold, but I found one on silver on the 4-hour chart, which led me to pick up the trade in combination with a strong score from the Edge Finder. This was up and away from there. But it wasn't just the US that had some poor jobs numbers. Also, we saw some really weak numbers from our northern friends, the Canadians. And I don't know if they're friends anymore. Nowadays, it seems like US and Canada are duking it out over tariffs and stuff. But the point is, there is a trend trend here in the North American countries that show some weakness in labor markets. And that could be a symptom of slowing economies. Take a look at Canadian unemployment, which ticked up to 7.1%. And the dollar is, as you might expect, tumbling lower here today off of what was, like I said, a pretty poor jobs number, which followed a string of poor jobs numbers. Let's take a look at the US economic heat map. The economic heat map is a tool that we use to spot the overall stats that we track for the US economy. Now, of course, we have this for lots of different economies. As you can see, we have EU, UK, etc. But today in focus, we're going to take a look at the US economic heat map. And what we can see here is, this is not a joke, the jobs gauge is like stuck on empty. It looks like it's ran out of gas and we're about to have to pull off and stop on the side of the road. That's how low the jobs data is looking. It's looking rough out there. We see ADP numbers missing expectations, NFP missing expectations, job openings weak, jobless claims. As we mapped out in the opening sequence of this video, jobs data is soft out there. And that's in combination with inflation that is a little bit sticky as well. All this to say, my bias on the US dollar remains bearish, and my bias on stocks also remains very cautious to bearish as well. Though on a technical basis, the dollar looks good bearish, US stocks are still in a strong uptrend, so I won't be shorting US stocks. Taking a look at the monthly chart on the US dollar index, ticker symbol DXY, we could still see that we are making our way back down towards the bottom end of this range. I would not be surprised at the least to see the dollar come back and test those lows and perhaps continue what has been a monthly downtrend in formation. Trading in the direction of this data would suggest that the weekly chart sort of reiterates the macro outlook, which is slowing economic reports in the United States. And I noticed on the weekly chart, take a look at this on the dollar index. Notice how many times we have attempted to move higher only to see sellers step back in and push this thing back down. I'm wondering if this NFP report could be the catalyst that takes us back down through the lows. And just take a look at yields. The 2-year government bond yield is plummeting here, down 3.23%, offering a yield of 3.476. This is on the decline as bonds become more attractive because the bond market thinks the Fed's going to cut rates. And who's to blame them? With the economy looking rough, it may be the right time to start cutting rates and protect ourselves from what could be an incoming recession. And there has never been a better time to start tracking the macro and making sure that you are trading in the correct direction. I call it the wind in the sail for a reason. At the end of the day, trading in the direction of where this data is suggesting markets could go is a superpower that most traders ignore. Most retail traders are focused solely on technical price action and completely ignoring the bigger picture, which is driving markets. Jobs data, growth metrics, inflation data, all this stuff is great, but having the right tools to track it makes the difference to making it from some sort of abstract idea that you know matters to something that is actionable to help you actually spot better opportunities. The Edge Finder is 40% off. And for subscribers of my channel for a limited time, we're offering 45% off if you use the first link in the description down below to send a direct message to our support staff. The reason we do it this way is so that you can communicate directly with a member of my team to make sure that the Edge Finder is right for your trading style. So send us a direct message, let them know any questions you have, and ask them about the 45% off discount, and they can get you our biggest discount ever. Start trading with the macro on your side rather than trying to blindly trade against it. So I just mentioned a word there, the fabled R word, recession. Are we in a recession? Are we turning into a recession? I think it's a little tough to say at this time, but I do think it is very fair to say that the economy may be showing severe signs of going from strongly growing to moderating or even modestly kind of just stabilizing, right? We don't necessarily need to be in a recession, but we could still just see a lot of the labor data coming in soft, suggesting that perhaps stocks have some room to pull back. Perhaps the economy is not all rosy and perfect. I mean, this jobs report is pretty terrible following a string of bad labor data. And those are the sorts of things that do lead us down the path of potential recession. Now, again, slowing does not necessarily mean, if this is the economy, right, we're growing, and then we start to slow, that does not necessarily mean that we have to go into a recession, which is a contraction of the economy. It could just mean that we are going to go through a period of slow growth before we ultimately accelerate again. It's very tough to try and predict these things. But my concern would be we've had a really great great expansive period. A lot of money printing from the government too has helped to support that. And with national debt at high levels, there is a risk that we may see slowdown as we kind of buckle under this very high debt level. That to me is a serious concern. And it's not just me, it's also the gold market. The gold market is flying high because the labor market data looks soft. National debt is super, super high, not just in the US, but across the globe. And I do think gold and silver are signaling there's some severe concerns about governments globally. But how can you actually place trades as an active trader? These are big abstract ideas. How can we place trades on it? Well, that is where the ultimate utility of the Edge Finder is culminated in the top setups page, which helps us to look at sentiment, technical, and economic data to help score, rank, and file to get ideas to potentially look for opportunities on. Like for example, my pound dollar long position that I took as it tagged support on the daily chart, I ended up closing this one for 126.7 pips this morning. Or my bullish play on TLT, which I'm up $690 on, as TLT has erupted higher as bond yields have dropped. Again, these are not blind guesses. These are trades, educated guesses, if you will, based on the macro that we just got done discussing. This trend in slowing economic data is something that makes me a little bit more oriented towards buying bonds, buying silver, buying gold, and just hedging out my portfolio a little bit, which is exactly why I've been selling calls against a lot of the stocks that I own. Like for example, Hood, ticker symbol HOOD. I sold covered calls on my position here. And if you follow my second YouTube channel, Trader Nick Stocks, yesterday I sold all of my NVIDIA shares. They're down 4% today, so I'm feeling a little bit like a wise guy today, if you will, following my sell of that. And if this does come down, I may be able to pick up my shares again for a lower price. By the way, check out Trader Nick Stocks if you're interested in finding out more about what I'm doing in my stock portfolio. Today's video is sponsored by DNA Funded. If you're looking to get funded this year and looking for a reliable prop firm to explore, and you are ready to take the challenge, meaning you are already at a point in your trading where you're feeling ready to take on these challenges and showing consistency, check out today's video sponsor, DNA Funded. They offer payouts in as low as 7 days. They have unlimited trading days on their 1 and 2 phase challenges, and they allow you to trade pretty much anything within one firm. So you can trade 800 plus different assets on their Forex and CFD based prop firm. Additionally, they're offering 20% off to my subscribers if you use the promo code A1T20. Down below in the description, you can find out more details.
Now it's the first Friday of the month, and that of course means it is non-farm payroll day in the United States where you are, and it's made fascinating reading. The US jobs market has weakened further in August, with employers adding just 22,000 jobs last month, and that is much fewer than expected, is it not?
It is, Johnny, and to put that into context, you're talking about a country that has over 300 million people in it. So just 22,000 jobs added for the prior month is a very, very weak number, missing expectations. And if we take a look at some of the recent months, right, we've had several poor jobs numbers on the non-farm employment change number. We've had, for example, the prior month we missed expectations and revised the prior month before that's numbers down significantly. So you've had this consistently downtrending labor market data. And of course, the market is all up in arms about this on whether or not the Fed is truly behind the curve now, with data really coming in soft throughout this entire week. We had pretty much a slew of weaker than anticipated jobs report data. Just to add some more context beyond just the NFP number, so we did get that 22,000 jobs number added, but we also did get a rise in the unemployment rate. We went from 4.2 up to 4.3%, which was in line with expectations, but a rise nonetheless. Average hourly earnings were mostly in line with expectations. But really, when we pull back the curtain and we look at like this week as a whole, we got quite a bit of concerning economic data on the labor side, right? The ADP non-farm employment change was also forecasted to come in around 73,000. That's the private payroll sector. It came in at 54,000. And you have unemployment claims, which also rose higher than expected, up to 237,000 weekly jobs numbers. So you put all this together and you say, okay, we truly do have some cooling labor data on the labor market. There's one other variable from Wednesday's reported JOLTS job openings numbers, which came in lower than expected at just 7.18 million. compared to a forecast of 7.38 million. That's a multi-year low. So it is fair to say that we have a labor market that is truly cooling here in the US. We do see the dollar significantly lower here today, off 0.73%. Most foreign currencies moving up against the dollar at this time. Gold looks, we just hit an all-time high, guys, 35.83. Let me ask you guys in the audience, can you give me your feedback on this? Do you think gold is going to 3,000? Which one's more likely? Is gold going to 3,000 or 4,000 first? They're about equal distance, maybe slightly closer to 4,000. Do you guys think gold is going to 4,000 first or 3,000 first? Let me know. I gotta say, to me, 4,000 looks like it could come in a hurry. Look at this move, right? That's $900 an ounce move, right? So to get another 425 points to the upside to get to 4,000, again, crazy. A couple years ago, guys, we were talking about $1,500, $1,700 gold. Fantastic move to the upside. And you know who's been on the long side? We've been ranting about this. You know who's been on the right side of gold? It may not surprise you that the big winners in gold, drum roll please, have been, ready? Let's go back. What do you want to do? 36 months? Let's look 36 months back. You know who's been buying gold? Starts with an I and ends with institutionals. Institutionals have been so long on gold for months and months and months, years and years and years. And we've been saying this on the channel because look at this yellow line. The yellow line shows you the long percentage of institutional transactions, right? We're looking at the commitment of traders data. This is not speculation. This is not trying to determine what institutions are doing from candlestick patterns. This is not rumors. This is not Wall Street bets. This is not any of that. We're straight up looking at the CFTC's weekly reported commitment of traders report to track what institutions are buying and selling. They legally are obligated to report this. We track it, and we have built a tool to be able to see what institutions are doing over time. Do you see what I see? The blue bars versus the red bars. Red bars are their short positions. Blue bars are their aggregated long positions, right? So if you pooled all their money together, that's what this software does. It shows you the aggregate. Institutions have been long. Anybody else lost money trying to short gold in the last few years? Because this might have been why. Institutions have just been riding this baby to the long side, and for good reason. They've been very correct in this idea. 3K, 4.236 extension of the 2020 to 2023 range has basically been hit. Cameron, thank you very much for the $5 donation to the stream. I greatly appreciate your support, and coffee this morning is on you. Thank you so much. Appreciate that. Yeah, I mean, it's valid to think that gold could have a pullback, but 3,000 seems really difficult to even see coming back into play. Could it happen? Of course it can happen. Markets are crazy and they can shock you. I just think that most likely path of least resistance is for gold to keep moving higher because again, they print dollars every day, but they can't print gold, right? They got to mine it. And that's a lot harder than printing it since it's paper, right? So, and nowadays, you know, banks, they don't even print physical currency. Most currency is created digitally through banks, right? So you have to be real careful. You know, if you're short gold, you're essentially long dollars. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.